Hello and welcome to the second part of the video about stochastic indicator. Last time we discussed the basics, i.e. what is stochastic, its real market usage, best settings for various timeframes, and today we will dive straight into ready-to-use strategies for trading, starting with divergence indication. So, when applying the stochastic oscillator on a chart, divergence occurs very rarely, but its signals are highly accurate. For instance, a bearish divergence when a price trend hits maximum, but the stochastic lines of %K and %D can't overcome the previously highest prices, marked with the blue line on the chart, on the overbought or oversold region, it means that there will likely be a reversal in the downward direction soon, and it works as a sell signal. Thus, we can open a short position after the indicator's moving averages cross and the signal candlestick closes. So in that situation, a bearish divergence occurs. So when the market price falls but %K and %D curves don't reach previous lowest prices marked with the red lines, it's a sign of the upward reversal. So we can open a buy trade after the cross and closure of the signal candlestick, of course. So when this phenomenon occurs, we say that the bullish divergence took place. And so a rough change that occurs either on the overbought or oversold levels is known as stochastic divergence. Entry signals are marked with black circles, based on the rules I mentioned, of course, a second ago. So you can recognize the bearish divergence from a bullish divergence in the overbought or oversold region. If you aren't sure, you should watch my previous videos on divergences where the issue is explained in detail. Over there, I described everything based on the MACD or MACD, if you prefer, indicator, but you can ignore the fact that there is a different indicator in the video. The principles are the same since the stochastic oscillator follows the classic rules of the technical analysis for bullish and bearish divergence convergence. So everything you will see in this video will work for the stochastic in order to efficiently monitor the price movement of our asset, as well as to have a better understanding of when a bullish or bearish divergence occurs. Okay, so let's discuss some setups. Bullish and bearish patterns looks the same as the stochastic divergences we mentioned a minute ago, but they provide different signals. A bullish pattern is adjusted when the new highest price forms a lower than previous high, but the stochastic has a higher than the last closing price. So it leads to a short-term price trend decline and a reversal. So this pattern should be used as a bullish entry point ahead of the upcoming rise. A bearish pattern occurs when the new lowest price has higher lows, but the oscillator forms a lower minimum indicating strong sell signals. So such types of price movement can be considered false signals, since later the price will rebound and reverse. Circles and violet lines mark local minimums on the price chart and the stochastic indicator. This means the formation of a bullish pattern that outruns the reversal signal. So there is a short-term price decline, which is the red area, when a trader can monitor how the spread bets a price reversal and a new bullish trend, which is the green area. So, stochastic is a technical indicator that provides a vast number of different signals. It can be applied to different trading methods, such as scalping, intraday, swing trading, etc. So now we'll discuss how to use the stochastic oscillator in different timeframes. First, let's look at how to add and set stochastic oscillator best settings for intraday timeframes. So to implement the technical indicator in the chart, press of course the button indicators and choose stochastic oscillator from the drop-down list. So most importantly, let's define the leading trend of the price movement. So we will do it using the stochastic with the 21, 7 and 7 parameters. It's essential to determine the technical indicator's direction and its location in the area above or below 50%. In our case, the blue main percentage K line is in the chart's upper zone and it's moving down, which you can see in the green oval. So therefore, we see that the downward movement is dominant. We must of course remember that intraday trading occurs on time frames that are not bigger than H1. For example, we will take the M31. The perfect settings for such a time frame are 5, 3 and 3. As the primary movement is downward during the day, we will look for a trading range when lines enter the overbought zone and percentage K crosses percentage D from the bottom up. So one such case is marked with the green oval showing the price range of our asset. We must remember that curves stay in the overbought area for a long time. That's why the upcoming downward movement is supposed to be stable and a strong sell signal is expected. So the next step is to identify the last closing price on a reversal pattern. An example of such a setup is depicted in this screenshot as doji. Still, there can be any other reversal combination of a candlestick's analysis and price action, and usually it appears near the cross of the percentage K and percentage D curves. On the chart, this pattern is marked with a blue oval. So when one of the following candles crosses a low point of the pattern, open a sell position at the price of 1.18329, which is on the level is marked with the blue line on the chart. So the stop loss is placed as always slightly above the highest price, which is the maximum point of the reversal pattern on the red line, and which is marked with the red line, and the take profit traditionally should be equal to the range of 2 times the stop losses. So when monitoring a trading range like this one, we can spot an alternative option to define the take profit level. So when the market price falls, relocate the stop loss to a break-even zone. Touching or crossing the 20% level will be a signal to close the position. In our case, such a situation is marked with a red oval. So you can fix your profit when the candlestick closes on a breakdown of the 20% line, which is the green line. It is of course also marked on the price of 1.17971. So as a result, this example yielded a profit of 35.8 pips or 358 points if you want to use full scale. So for this scalping strategy, we will use a 5-minute time frame, and the stochastic settings of period percentage K is 10, period percentage D is 7, and length is 3. So big trading range periods for such a time frame will be compensated by changing the limits to 30 and 70. So you can change these parameters in the style section, style tab of the indicators settings. Okay, so we will buy if the following conditions are met. Lines are on the border of 30% or beyond, and percentage K crosses the percentage D from the bottom. As for the conditions for sell trade, lines are on the border of 70% or beyond, and percentage K crosses the percentage D from the top. Stop loss is set at the extreme of the local minimum of 3 to 5 previous candles. The take profit is placed at a distance of the stop loss, or you can add to it 5 to 10 pips. So it is recommended to trade with a small fixed lots, of course, and the blue circle points at the cross of the percentage K percentage D lines upside down above the 70% level. So we open a sell position at the close of the candlestick, which is the blue line. And the stop loss is placed at the local minimum, the red dotted line, and the take profit is almost at the same distance, the green line, of course. So as we can see from the chart, the trade was successfully closed at the take profit level. And so to open a buy trade, the steps are of course similar. In the chart here, there is an example of the scalping strategy for a long trading range. As we can see, the price hasn't reached the take profit level but turned around. So you should be ready for such situations, as sometimes stochastic indicators provide fake signals when trading currency pairs, for example. Profit is gained due to narrow stop losses and plenty of trades, but most of them should be profitable. Next is swing trading. So to understand the stochastic swing strategy, we should learn the star pattern. So there are two types. The morning star consists of 3 consecutive bars. The first one is bearish with a long body. The second one forms with a gap, ideally, of course, with a gap, with a bottom shadow and a short body. So the third one is bullish with a long green body that overcomes the most significant part of the first candle's body. The opposite is the evening star. It includes 3 bars. The first one is bullish with a long green body. The second one has a short body and a gap, ideally, of course, again. And the third one is with a bearish long red body covering the most significant part of the first candlestick. And to be completely honest, the ideal version of the pattern occurs rarely as well, but it's vital for the one in the middle to have a long shadow in the direction of the completing trend, and for the next candle to have a long body. So at the same time, the longer the body, the more reliable the signal is. In an ideal scenario, it should cover several previous candles. In the screenshot, you can see an example of the shooting star that doesn't correspond to all the rules that provides a strong sell signal when trading. So we will use the best stochastic settings for swing trading, and these are 5, 3, and 3, which provide sufficient signal density. As for conditions for a long position, so first one, stochastic is below the 20 level. There is the second one, there is a morning star pattern at the reversal. And the third point, the market starts moving upward. So the conditions for a short position, again, the opposite version. Stochastic is above the 80 level, there is a shooting star pattern at a new reversal, and the market starts moving down. So we should open a trade as soon as the bar after the pattern crosses its extreme in the trend direction. So the stop loss is set at the maximum point of the star, we should say, and we will close the position as soon as is a cross of stochastic lines either above 80% or below 20%. And so in the chart, you can see the shooting star formation with the simultaneous crossing of the indicator lines in the overbought zone. There's the blue circle. And so to make it more transparent, look at the zoomed in picture of the pattern. We opened a trade at 1.37637. When the bar crossed the pattern's minimum point, which is the blue line, a signal to exit the market was a curve cross marked with the red circle. We fixed the profit at 1.34695, the close of the candlestick at the same time. And so the final profit was 2,942 points. We must remember also that each instrument shows its own behavior, and it's crucial to consider it when trading.